All right, here we are with our notes receivables example. In this one, it says Kilo Company loaned $50,000 to Lima Company on July 1st after they signed a 9-month note and agreed to pay 6% interest. Lima Company pays off the loan plus the interest in full on the date of its maturity. Journalize all the relevant entries. Now, this is only one example of three that we're going to do in this video, but this one I want you to notice that it's a 9-month note and it starts on July 1st, which means that we're going to go past December 31st. It's going to go past December 31st, which means we have to stop on December 31st and do an adjustment for the interest that we have earned. So we'll do that in this one. So the first thing we need to do is to just journalize us giving the loan. So we are giving out cash and we are going to be getting a notes receivable back. So it'll be 7-1. We will put notes receivable as our debit because we're increasing what we're owed of 50,000 and our cash goes down by 50,000. That's why we're crediting. And that happens on 7-1. And then, the normal year of operations entries happen and everything. Then we get to the 12/31. That's the next date of significance. And in that one, we need to calculate how much interest we've actually earned through this process since July 1st. And so the way we do that is the principal amount times the interest rate times the time expressed in fractions of a year, and that's going to give me my total interest. So if we put the numbers in each of these, so our principal amount, we have 50,000. Our interest rate says 6%, so we'll put 0.06. Our time expressed in a fraction of a year. So this is a 9-month note, so we would do 9 months over 12 months. That's the proportion of the year. And if we multiply all that out, that's going to give me a total of 2,250. Now, that is the total expense, that's the total interest that is going to accrue over the life of the note. But that's not how much it's accrued up to December 31st. Now we've got to calculate how much it's going to be up to the December 31st. So for that, we would do total interest times the amount of time from the start date to December 31st. And that's going to give me my interest accrued by December 31st. So my total interest we just said was 2,250. The amount of time from start date to December 31st, well, you got to count July because it's July 1st. So July, August, September, October, November, December. That's 6 months. So 6 over the 9 months that is the note's for. So 6 over 9. And that's going to give me a total interest for this portion of the year of 1,500. So I've accrued 1,500 of the total 2,250 of interest that's accruing as of December 31st. So now I need to do the journal entry. So that is my interest that I've earned, but I haven't got it in cash yet. So I can't put it in cash yet. I'm expected to receive it. So I'm going to debit a receivables account. More specifically, I'm going to debit interest receivable because this is the receivable I'm owed in interest of 1,500. And then I'm going to credit interest revenue because this is the revenue that I've made from interest up to this point. And so that's December 31st of the first year. Now I get into the second year. And the first date of significance of the second year would be when it matures, which is 4/1, April 1st. And on that date, we got to calculate how much interest that we've had. Now, there's two ways to do this. Obviously, you can go 2,250 minus the 1,500 because it's the total minus what we've already done. That's going to give you a number. Or you can do it the other way. I'm just going to do it the other way just to show you again how to do it. So again, it is the total interest times the amount of time from January 1st to maturity date. And that's going to give me the remaining interest accrued. So again, our total interest that we're going to have over life is going to be 2,250. The amount of time from January 1st to this maturity date is going to be 3 months, so 3 over 9. And that will give me the remaining 750. All right, so now that I have all that, now I can do my final journal entry of them repaying us. So what am I getting? I'm getting cash. How much cash? Well, I'm getting everything. I'm getting not only the 50,000 in principal, but the entire interest, which is 2,250. So if I add that together, that's going to give me 52,250. And what am I going to be crediting? Well, one, they're getting rid of their notes receivable. So I'll credit notes receivable for the principal amount, which is 50,000. I'm also getting rid of their interest receivable that they have back in 12/31, which is 1,500. So credit that. And then the final 750 is the only piece that I haven't recognized as revenue yet. So I will finish recognizing that as revenue, as interest revenue specifically of 750. And that is how you do that journal entry or that series of journal entries for this example. Now, the next one, I'm going to change a couple things here and there. So we're still dealing with Kilo Company and Lima Company, but look at this information. It says that it was on February 1st that Lima signed a 9-month note and agreed to pay 6 months. Lima pays off the loan plus the interest in full on the date of its maturity, blah, 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 blah. So this time again, we're going to do 2-1, notes receivable, 50,000, cash, 50,000. That doesn't change. But this is a 9-month note that started in February 1st, which means that we're not going to pass December 31st. So we do not have to stop and do an adjustment in the middle. We're just going to go right into the payment of. So it's going to mature as of 11/1. Again, how do we do that? How do we calculate that? Well, this time we only have to do this equation one time because, again, we're not having to do it at December 31st and at the end. We're already at the end. So our principal amount is 50,000. Our interest rate is 6%. And our time expressed in a fraction of a year is 9/12. And that's going to give me, again, 2,250. So what are they paying me? Well, they're paying me cash. And it's going to, again, the payment is going to be the principal plus the interest, so 52,250. They're getting rid of their notes receivable, which is the principal of 50,000. And then we're going to recognize the 2,250 as a revenue because there's no need to put it into a receivable right now. So we'll put it in as interest revenue of 2,250. So that's how you do an example of this if it happens within the year, so it doesn't go into the next year. All right, I'm going to show you one more example of this. This time it's going to be in days, just to kind of give you another idea of how this works. So Kilo Company loaned $50,000 to Lima Company on November 1st after they signed a 90-day note and agreed to pay 6% interest. Lima pays off the loan plus the interest in full on the date of its maturity, journalized through all the relevant entries. So we're at 11/1 again. We'll do notes receivable and cash because, again, that's just recognizing the principal loan. We'll go through the rest of the year, and then we hit 12/31 because this is one that goes past December 31st. So we have to stop and do a 12/31 adjustment. So we need to do the calculations again. Again, it's the principal amount times the interest rate times the time expressed in a fraction of a year. So our principal, again, is 50,000. Our interest rate is, again, 6%. But this time we're going to be doing it in days because that's what the information is given to us as. So we're going to use the banker's rule. So it's 90 days over 360 because we assume that the year has 360 days. And if I do that, that's going to give me a total interest over the life of the loan or the note to be 750. That's not what I need because I'm only looking at it up to December 31st. So I need to do another calculation of that 750. So it's going to be the total interest times the amount of time from the start date to December 31st, and that'll tell me how much of that interest I've actually accrued and earned. So 750. Now here's the fun part. You're just going to break out a calendar and count the days to see from November. You're going to start on November 2nd because it's the day after November 1st. So November 2nd will be day 1 all the way to December 31st, which will give you nicely 60 days. So we'll do times 60 over 90, and that will give me an interest that we've accrued up to December 31st to be 500. All right, so to finish up our journal entry for this one, it would be interest receivable because we're not getting cash yet. They still owe us of 500. And then interest revenue because we're going to go ahead and claim it as revenue because we earned it in this year of 500. Then we go to year 2. They're going to pay it off. So now we're going to go into 130. That is 90 days past November 1st. We need to calculate the rest of it, which, again, if you do 750 minus 500, I'll give you 250. But just to show you it does work out that way, it is going to be 750 times the remaining 30 of the 90 days. That will give you the remaining 250. So what am I getting? I'm getting cash. So my cash is going to go up. They're paying it off. So I'm going to debit cash for how much? Well, I gave them 50,000. So that's the principal plus the total amount in interest, which is 750. So that's going to give me 50,750. They're getting rid of their principal, so I'm going to credit notes receivable of 50,000. They're getting rid of their interest receivable from December 31st, which is going to be 500. And that remaining 250, I still need to recognize as revenue because I haven't done that yet. So I'm going to claim that as interest revenue of 250. And that is how you do 3 examples of notes receivables examples. So hopefully they made sense. Hopefully you're able to keep them apart and see the differences between the two. But if you have any questions, please leave them in the comment below. Y'all have a good one.